Hello folks and welcome to the Options Linebacker Top 10 Market Lessons for 2008. Lesson number 10, follow the 2% rule. What is the 2% rule? It's money management. It's defined as the maximum amount a trader may lose in a single trade without damaging his long-term prospects is 2% of their equity. I got this from an Alexander Elder book called Trading for a Living. Sizing positions based on this 2% max loss instead of the credit that you expect to earn. As of 1 year ago, Options Linebacker max position size is now 10% of account equity, which does fit the 2% rule at the maximum pre-designated debit. The newer delta neutral trades that we're doing in the newsletter are already designed with this 2% rule in mind. Lesson number 9. This was a lesson for me. It's a bear market, stupid. A look back at my trading results shows that I have not closed down a full bear call spread position since April of 2007. That's almost 2 years ago. The last time we even had a partial close was during early October at the very top of the bull market. So that's over a full year of 100% winning bear call spreads. Every bear call spread that we put on, we won. Hello? The focus here is to manage risk and complete the iron condor with put spreads whenever possible. However, it's a bear market, so we need to be very cautious before trading to the south and to be more aggressive on the top side until the market tells us otherwise. Lesson number 8, never stop seeking an edge. Our main edge is selling a depreciating asset, selling options, which gives us an edge when charts go sideways. But that's not good enough these days to just use simple edges of time value erosion and technical analysis. This is war and survival of the fittest to get through a bear market. Everybody gets hurt in a bear market. So you've got to constantly refine your edge to survive the bear, to get through that and get to the easier markets on the other side. Refining your edge does not mean constantly seeking the Holy Grail by jumping from strategy to strategy. It means really digging into your results to see what improvements or skill reinforcements that you need. Lesson number 7. Never ever hold a euro-settled index product over expiration. Now this was a lesson from 2007. It was on our top 10 list from 2007. We've added a little twist to it for 2008. These are index products like the S&P, the Russell, the DJX. These use European cash settlement process. So it's not the price of where the index stops trading on Thursday of expiry, but where it settles on Friday morning's opening print of all the stocks. So we thought the August 2007 settlement gap was 40 points. We thought that was bad. Well, that was nothing. September 2008, we had a 72-point gap on expiration day. This was caused by an SEC naked shorting ban that was instituted the night before without warning and caught the bears by surprise. So, again, for 2008, do not hold euro-settled products over expiration. It cannot be any more clear than that. Lesson number 6, match your trade requirements to the available brokers. There's not a better time in the history of trading to be a retail customer. We have fantastic choices of options brokers, and the story continues to improve. So there is a perfect broker out there for you if you trade a lot of contracts and you need wholesale execution of spreads, if you do delta neutral or Greek space trading and you need advanced tools for that, or if you just need a high-touch consultative services to go with your option trading, there's a broker for that too. You can improve your edge if you match your broker to your desired strategy. So view the Options Linebacker webpage to find out more, which is optionslinebacker.com/brokers.html. Lesson number 5, don't panic. Have a plan. Do you have a trading plan? If you don't trade again until you have one in place. Take the next week off, put a trading plan in place. You cannot be expected to make a rational decision in a market that can move 80 S&P points in a day against your position. Nobody can. Trading is not what you see on TV. It's not about slinging positions around in the heat of battle. It is the cool execution of a trading plan that was drafted during quiet times, not during when the market's open. Judge yourself by your ability to follow your plan and not on your decisions that you make in the heat of the moment. Try to reduce those. And lesson number 4, there is no holy grail. Many traders are forever in a spiral of chasing after the elusive holy grail of trading. As soon as they take a loss in one strategy, they abandon it in favor of the latest hot strategy or guru that they heard from friends. Usually by the time they join, they're late to the party and they will subsequently take a loss on that guaranteed new strategy just as they jump on board. So the lesson here, get good at one thing and build on top of that. Don't abandon your skill sets. A consistent, disciplined approach will always beat out a knee-jerk, reactive one. A quote from Tom Sosnoff of Thinkorswim was, "Nothing worked." And he was talking about the October 2008 crash. He said nothing worked. No strategy out there really survived that unless you were heavily short or you're an experienced day trader. So unless this style of trading fits your skill and risk profile, stick to your core strategies. Don't base your long-term trading strategies around something that happens once every 80 years. Lesson number 3, trading mindset is more important than trading skills. Trading mindset is the most important trading skill. You can have great technical analysis or option strategy skills and knowledge, but it means nothing if you do not understand how you make decisions or apply your own cognitive biases to your read. The only way that you'll find out about these is to journal your trades, which includes capturing your feelings that you experience while you're making decisions. And then you have to complete that feedback loop and analyze how your biases affected your decision-making process. This is where an objective accountability team can pay huge dividends because they're going to see things that you don't. Lesson number 2, trade smaller positions more often and on different charts. So we're going to trade smaller and diversify. Just because there's a 2% rule for money management doesn't mean we need to trade positions that are even that large. In 2008, what we had to do was we had to strive to spread our risk around as much as possible compared to earlier years. We used to be able to just park these huge positions outside of support and resistance and just let them bake for a few weeks. No longer. So now I'm striving to spread risk around on different charts, different levels, all over the place so that no one position will ruin my month or my year. And finally, lesson number 1, anything can happen. Who's this guy? His name is Burton Malkiel. He wrote a book called A Random Walk Down Wall Street. His basic thesis in the book is that technical analysis is worthless because stocks follow a random and unpredictable path. I personally argue that technical analysis works about 95% of the time, but it's at 5% of the time that we have to prepare for. What was thought to be impossible has happened in 2008. A VIX of 80? Get out of here. So anything can happen. Be on guard. Be prepared. Big moves happen during periods of complacency when people are not looking for them. So thanks for watching the top 10 lessons for 2008. I am looking forward to a very exciting and probably continuing dynamic 2009 market. All we need is an open market, and we have opportunity. So the opportunity is there for the prepared trader. Have a safe New Year's, folks. Take care.